Imagine if you could read a price chart like a detailed map, a guide that clearly shows you where a market might be heading next. With this skill, you could confidently identify promising locations to enter a trade and sensible points to exit. This is the ability that countless aspiring traders seek, yet many try and ultimately fail to master it. They look at the endless wiggles and jiggles on the screen and see only confusing chaos. The good news is that you don't need a complex system to begin. You can learn the fundamental basics quickly, and this essay is designed to show you how. We will break down simple chart lessons and provide a clear, actionable trading plan you can practice right away. The primary problem for new traders is not lack of intelligence or desire. It's a lack of a simple, repeatable plan. Trading can seem overwhelmingly difficult at first. Charts often look like random noise, a jumble of red and green lines. People jump from one complicated trick to another, constantly switching strategies. They take oversized risks, fueled by hope or fear, and many lose money. This cycle of failure happens for a few key reasons. Traders operate without a simple plan. They fail to control their risk. They ignore the market's underlying trend. They make decisions based on volatile emotions rather than steadfast rules. Our goal here is straightforward and attainable. We will learn 3 fundamental chart tools. With these tools, we'll build one clear, easy-to-follow strategy. A core component is managing risk, so no single trade can severely hurt your account. The objective is to trade with predefined rules, not on whims. Follow the step-by-step process to bring order to the chaos. This essay will guide you through each step in a calm, friendly way. The approach is intentionally simple. Complexity often creates confusion and error. Focus on basics to build a strong foundation. This essay won't promise instant riches or flawless wins. Instead, it offers a practical path toward competence. Learn to read the map, understand the terrain, and navigate with a clear plan and protection for your resources. Let's begin to demystify the charts and build a plan you can trust. To navigate the market, you must first learn to read its language. Price charts communicate a wealth of information, but you need the right tools to translate it. We will focus on 3 simple yet powerful tools that form the bedrock of technical analysis. The first is the candlestick chart. Each candle is a visual representation of price movement over a specific period. 1 minute, 1 hour. One day, a candle provides 4 key pieces of data: opening price, highest price, lowest price, closing price. A green candle typically signifies the price closed higher than it opened, buying pressure. A red candle means the price closed lower, selling pressure. Many candles of the same color in a row visualize trend and momentum. The second essential tool is the trend line. In an uptrend, draw the line connecting progressively higher lows. That line acts as a floor, support. In a downtrend, connect progressively lower highs. That line acts as a ceiling, resistance. Trend lines give a visual boundary for the prevailing trend. Price bouncing off the line keeps the trend intact. A decisive break warns momentum is fading or reversing. Our third tool is the moving average. A moving average smooths price data by averaging over a number of periods. Example: a 20-period moving average shows the average close of the last 20 candles. It filters short-term noise to reveal the underlying trend. Price trading above the MA. General uptrend. Price below the MA. Possible downtrend. MAs can act as dynamic support or resistance. Candlesticks. Trendline moving average. Candlesticks show buyer and seller psychology now. The trend line gives a visual boundary for the primary direction. The moving average confirms direction and shows trend strength. Use these 3 to cut through noise and read supply and demand over time. Mastering them is the first step toward trading with confidence and clarity. Now that we understand our 3 basic tools, we can combine them into a simple yet effective trading strategy. This strategy is called the trend follow break. It's designed specifically for beginners because it relies on clear, objective rules that are easy to identify and follow. The core philosophy: trade in the direction of the main trend. We're not trying to predict reversals or catch falling knives. We're simply looking to join a trend that has already established itself. That alignment increases our probability of success. This strategy uses a candlestick chart, a trend line, and a moving average. First step, establish the setup on your chart. Choose a time frame that fits your schedule. For many beginners, the 1-hour chart or the 4-hour chart works well. Next, add a 20-period moving average to your chart. This is your primary trend filter. Price consistently above the 20 MA, only look to buy. Price below the 20 MA, only look to sell. That single rule prevents you from fighting the market's main current. Once trend direction is confirmed by the MA, draw a trend line. In an uptrend, price above MA, find 2 clear low points and connect them with an upward sloping line. In a downtrend, price below MA, find 2 or more clear high points and connect them with a downward sloping line. After drawing the line, wait patiently. Wait for price to pull back and test the trend line. Patience prevents chasing price and helps you enter at a better level. Final decision: trade a bounce or a break. For this strategy, we focus on a bounce. Wait for price to touch the main trend line and then show rejection, confirming likely continuation. The signal often appears as a reversal candle, for example, a green bullish candle, right after touching the uptrend line. Confirm trend with the MA, draw the trend line, and wait for a test. This creates a high probability setup ready to resume the primary direction. Having a solid setup is only half the battle. You also need precise rules for when to enter and exit a trade. These rules must be objective and non-negotiable, removing emotion and guesswork from your decision-making process. Let's outline the specific entry rule using a buy example. Condition: price trading above the 20-period moving average. Condition: valid uptrend line connecting at least 2 recent lows. Wait for price to pull back and touch the uptrend line. Signal: a solid green candle forms. Signal confirmation: that candle closes after the touch. Buyers are stepping back in and defending the trend. Entry: take position at the close of the signal candle. Now define risk. Set a stop loss immediately. Stop loss defined: a predetermined price to exit for a small acceptable loss. For the buy, place stop loss just below the recent swing low at the trend line. Reason: if price breaks below this, the uptrend is invalidated. Finally, set a profit target. Use a fixed risk-to-reward ratio, e.g., 1.2. Example: risking $50 means targeting $100. Now the sell rules mirror opposite. Condition: price trading below the 20-period moving average. Condition: valid downtrend line connecting at least 2 recent highs. Wait for price to rally up and touch the downtrend line. Signal: a solid red candle forms. Signal confirmation: that candle closes after touching the line. Enter by selling at the close of that signal candle. This disciplined waiting and confirmation filters weaker signals. Exit logic: same as buy, but reversed. Stop loss for sell: placed just above the recent swing high at the downtrend line. This protects against further upward movement and defines max risk. If price breaks above this high, the bearish setup is invalidated. Profit target: again use RR of 1.2 or higher. This makes winners significantly larger than losers, key for long-term profitability. Follow these exact rules for every trade to build discipline and consistency. Trading without a strict risk management plan is not trading at all. It is pure gambling. Your number one job as a trader is not to make money, but to protect the capital you already have. If you can do that effectively, the profits will eventually follow. The first and most important rule of risk management is to risk only a small percentage of your trading account on any single trade. A professional standard is to risk between 1% and 2% of your account balance. This means if you have a $5,000 trading account, you should not risk more than $50 to $100 on one trade. This rule ensures that a string of losing trades, which is inevitable for every trader, will not wipe out your account. It keeps you in the game long enough to find the winning trades. The second rule is to use a stop-loss order on every single trade without exception. A stop-loss is your safety net, your ultimate protection against a catastrophic loss. Once you have determined the logical placement for your stop-loss based on your strategy, you must set it and not touch it. A common and destructive mistake traders make is moving their stop-loss further away from their entry price to give the trade more room to breathe. This is an emotional decision that invalidates your entire plan. Your initial stop-loss placement was based on logic. Moving it is based on hope, and hope is not a strategy. Accept the small loss when your stop is hit and move on to the next opportunity. The third rule is to calculate your position size correctly. Proper position sizing ensures that when your stop-loss is hit, you only lose your predetermined risk amount, for example, 1% of your account. The size of your position should be based on your stop-loss distance, not on a random number of shares or contracts. You can use a simple formula. Position size equals total account risk in dollars divided by stop-loss distance in dollars per share. Finally, a key part of risk management is to avoid overtrading. True trading is mostly waiting. You must have the discipline to sit on your hands and do nothing until your specific rules for a high probability setup are met. Trading less but with higher quality setups is far more profitable in the long run than trading frequently with mediocre ones. By keeping your risk small, always using a stop loss, sizing your position correctly, and trading only your best setups, you build a defensive wall around your capital that allows you to trade for the long term. Let's make these concepts concrete by walking through a hypothetical trade from start to finish using easy-to-understand numbers. Imagine you have a trading account with a starting balance of $5,000. You have committed to a strict risk management plan, deciding to risk no more than 1% of your account on any single trade. This means your maximum acceptable loss per trade is $50, which is 1% of $5,000. This $50 is your North Star. Every decision regarding the trade's size will be based on this number. You are scanning the charts, and you identify a potential buy setup on the stock of a company. Let's call it ABC Corp. The stock's price is trading clearly above its 20-period moving average, confirming a healthy uptrend. You have drawn an uptrend line connecting the last two significant lows, and you notice the price has just pulled back to touch this line. After the touch, a strong green candle forms and closes, giving you the entry signal your plan requires. The closing price of this signal candle is $50 per share. This is your entry point. According to your rules, you decide to enter a buy order at this price. Before you can determine how many shares to buy, you must first define your exit point if the trade goes wrong. You look at the chart and see that the most recent swing low, formed at the trend line, is at $47.80. To give the trade a little bit of space, you decide to place your stop loss just below that, at $47.50. The distance between your entry price, $50, and your stop loss price, $47.50, is $2.50. This $2.50 represents your risk per share. Now you can calculate your position size using the formula we discussed. Position size equals account risk divided by risk per share. In this case, it is $50 divided by $2.50, which equals 20 shares. You would therefore buy 20 shares of ABC Corp. With your entry and stop loss set, the final step is to define your profit target. Your plan calls for a risk-to-reward ratio of 1 to 2. Since you are risking $2.50 per share, your target profit will be twice that amount, which is $5 per share. You add this to your entry price, $50 plus $5 equals $55. You set a take profit order at $55. Now the trade is fully managed. If the price drops to $47.50, you will lose exactly $50. 20 shares times $2.50 loss. If the price rises to $55, you will make a profit of $100. 20 shares times $5 gain. This structured process removes all emotion and ensures you are always trading with a positive risk-to-reward profile. We have covered the foundational elements of a simple and logical trading plan. Let's briefly recap the key steps to solidify them in your mind. First, use a 20-period moving average to identify the primary market trend. Rule: only look for buys above the average, sells below. Second, draw a trend line to visualize trend structure and a high probability entry area. Third, wait for a clear entry signal, a bounce off the trend line confirmed by a strong candlestick. This discipline of waiting is paramount. Execute trades using clear rules for entry, exit, and risk management. Entry: at the close of the signal candle. Exit: predefined exit rules. Risk management: position sizing and stops. Place stop loss at a logical level that invalidates the trade idea. This keeps losses small and manageable. Set profit target at least twice the size of your potential loss. 2.1 RR. Risk only 1% to 2% of your total account on any single trade. Calculate position size based on stop loss distance. These rules form a complete system to guide decisions. Don't underestimate the psychological component of trading. Having a plan is one thing. Having discipline to follow it after a loss is another. Trading requires patience and emotional control. Accept small losses as normal. Don't let them affect the next trade. Let your winners run to their target. Don't cut them short out of fear. Focus on flawless execution of your plan, not the outcome of one trade. Next action: practice without risking real money. Open a demo trading account and apply the trend follow break strategy. Use the checklists for every trade. Journal each trade. Why you entered. Journal where you placed your stop and target. Journal what the outcome was. Review your journal weekly. This builds chart skills, discipline, and confidence before risking real money. Start small. Stay patient. Never stop learning.